Hello everyone, in today's video, I'm going to cover my entire stock portfolio. I'm doing this because I wish more people would do this who are talking about stock investing. Why won't they reveal their portfolio? So I don't want to be one of those people who just don't reveal their portfolio. So I'm going to do this today. I'm going to cover all the ups and the downs and the percentage each of these stocks make up in my portfolio. So you'll notice that I'll cover value stocks, dividend stocks, growth stocks, and of course, there's going to be Canadian stocks in there. And most importantly, I'm going to talk about everyone's favorite topic, which is taxation. I know you're like, what? Yeah, what's that? What? No, okay, I know it's not exciting, but you know what? It's so important because as a Canadian, there's so many different types of accounts. There's the tax-free savings account, there's a registered retirement savings plan, there is registered education savings plan, I think, or whatever that RESP, and then there's also corporate account. And some stocks are taxed pretty heavily depending on what type of account you choose to put it in. So it's going to be a pretty important topic. I'm going to try and make it as exciting as much as possible for you when it comes to talk about taxation. Also, I thought it might be good to just look at someone else's portfolio like mine so that you can have something to aspire to because like it took time to get here, and I just want to show you like if you waited long enough and you pick the right stocks, it can grow beautifully for you. Everyone, if you want me to create more of these videos for you where I reveal my portfolio, be my real estate portfolio, be my stock investing portfolio, hit that like button, smash it, hit it. So you let me know to create more of these videos for you. And everyone, if you are new to this channel, why aren't you subscribing? Hit that subscribe button and that bell notification button so you get every one of these videos coming to you every single week. Plus, it's free. So let's get back with the video. Okay, I'm going to reveal my entire stock portfolio. So I'm going to talk about whether it's a dividend stock, whether it's a Canadian stock, whether it's undervalued. At least when I bought it, I thought it was undervalued, or if it's a growth stock. Because the three investing styles I do is dividend investing, value stock, and growth investing. So let's dive in. The first stock is Algonquin Power. This is a beautiful Canadian stock. Made a position in it because it has reliable dividends. Now, with any dividend stocks, they don't really grow. They're actually one of the boring stocks, and that's what I have is a boring Algonquin Power utility stock, which supplies power. And I made this position a couple years ago, dollar cost averaging over time, and now it's up only 2.6%. But again, beautiful dividend stock. Next one is Alphabet. Now, everyone knows Alphabet, it's Google. So I made this position because, well, it has a beautiful financial spreadsheet, has really strong fundamentals, it's a great financial position. It's a cash king. So I invested Google about last year, and it's up by 4.6%. Right now, my next position is another tech stock. It's a US tech stock, which is Amazon. Now, I started making this position because of its big growth sector, which is the Prime and membership and its fast delivery. So I made this position starting in 2017, and of course, the rest is history. It has gone up 98.5%. It's one of those stocks that's called a growth stock. While Google, I'd say it's more of, I would say, more of a value stock rather than a growth stock. It hasn't been growing like crazy. It's more like one of those stocks that has really strong fundamentals, and that's why I invested Google. And some people would say it could be a growth stock because it is growing 10% year over year in its revenue, but the stock hasn't really grown that way. So I'll wait and see. The next stock is Apple. Now, I made this position. This was back in 2015. This was the very first stock that I've kept for a very, very long time, since 2015, starting with $5,000. And of course, I've been picking Apple up every time it had its pullback and been making bigger and bigger positions. Now, I made a big mistake actually since 2015, which is I sold a bunch of Apple stocks. I sold 100 shares. I had, I think, 250 shares at one point. Anyways, I think I sold 100 shares, and I wish I didn't because obviously Apple has been growing beautifully. Anyway, I was not as confident in Apple. I wanted to get my principal back so that I let my money run. Like basically it's free cash at this point. And with this free cash has gone up 175%. But if I kept all my positions, of course it would have grown more, but oh well, that's life. And again, Apple back then, the reason why I invested in Apple back in 2015, it was heavily undervalued. It had a price per earnings of like, I think 12 or 11, like well under 15. It was like 13 at that point. That's why Warren Buffett was making bigger positions Apple, and I was also making bigger positions. Of course, not as big as Warren Buffett. Now, the next one is Aritzia. It's a Canadian retail stock. Now, this stock, I love its brand. It is growing steadily. The revenue and its financial position is very strong. So I've been investing since last year. Now, of course, during this pandemic, it hasn't been treating the stock very well, and it is down 14.4%. But I made this position in this stock because I think at that time I thought it was undervalued. Now, it's yet to prove itself, so I'll wait and see. And I've been buying more and more positions during the pandemic because, of course, it was exceptionally undervalued. But we'll see. It's going to probably take a few years before this stock does anything. The next one is ARK ETF Trust. Now, I love Kathy Wood. She is one of my favorite investors in the entire world. I love her company. I love the way she invests in disruptive technology. So rather than me trying to understand every company she invests in, I'll just invest in her fund, which is the ARK ETF fund. And they invest in genetics, like CRISPR. They invest in Tesla. So anyways, I bought a few positions in there, and I bought it earlier this year, and it's gone up 12.2%. The reason why I invested ARK ETF, because that's my way of trading like an index fund. Now, this is like a smaller index fund, which is on disruptive technology. So rather than me trying to understand every one of those stocks, I just made a position in it, and I'm just going to ride on its investments. So it's neither a value stock, it's neither a growth stock, it's neither a dividend stock. I would say some people would consider it growth stock because it's grown beautifully in the last 5 years, but it is an index fund that, I guess, an index growth fund. The other stock I'm going to talk about is Bank of Nova Scotia. It is a dividend, beautiful stock. It is a dividend stock. And this stock has been growing year over year in its dividends. Now, again, like I said, with the dividend stocks, they are very boring, and they actually don't do very much over the years. But of course, during the pandemic, a lot of bank stocks like Bank of Nova Scotia haven't been doing so well, so they are down by 15.8%. And I've been buying that for a couple years now. The other stock I have is Berkshire Hathaway. Who needs to why I don't even need to talk about Warren Buffett. This is the reason why I invested in Berkshire Hathaway stocks. Now, it's a bit actually quite volatile over the last few years. I mean, they haven't been doing so well because they've been selling their airlines and energy stocks. And so really, they haven't been doing much. And so I am actually only up 3.7%, even though I've been buying them for about 4 years. My next stock is Canadian Western Bank. This is another Canadian stock. And the reason why I bought them is because it is a beautiful dividend stock where they've been growing their dividends year over year. Now, again, this is a bank stock. Bank stocks aren't doing so well, so it is down 20.8%, but that's okay. I'll just take its dividends. I'll just ride this stock out. The next one is a speculative stock. I made a position in Cloud MD software because it went initial public offering this year. And I rarely, but still do, invest in initial public offering companies because of their business model. This one is virtual medical appointments in hospitals, just physician appointments. And anyways, I really like their business model. They've been acquiring more and more different types of clinics. So are steadily growing, and it's been reflective in the stock price, which has been up by 25.7%. Now, this is what I would call a growth stock, but very speculative growth stock because they have yet to prove themselves. So let's just see what they will do. The next stock is another dividend king, which is Enbridge. And check out this video up here where I talk about Enbridge. It's been paying out its dividends for 65 years. So I've been making a position in Enbridge for about 4 years now, dollar cost average. And like any dividend stocks, it hasn't been doing much over the past 4 years. It's only up by 6.2%, but I love its dividends. The next one is another bank stock. And this bank stock is one of my favorite bank stocks because I love their business model. I actually have my money saved in EQ Bank, and they're all digital. And I really just like what they have to offer. So I made a position in EQ Bank because it's a dividend grower. It's been growing its dividends year over year for many years. That's why I made a position in EQ Group, even though its dividend yield is not that high, but it's pretty predictable and it's a dividend grower. But it is down by 28%. So the next position I have is Facebook. And Facebook is one of those stocks I still considered undervalued. Now, it's pretty close to intrinsic value, a little bit undervalued, but even more undervalued a couple months ago. Anyways, I've been making more position in it. I'll be making bigger positions in it because it's one of those stocks that has a beautiful fundamentals. It's a cash king. It's growing its revenue model, at least I think 13%, which is double the revenue growth rate than Apple right now. Anyway, Apple, started making position actually during the pandemic, and because I thought it was severely undervalued, and it's gone up by 25.1% since over the last few months. Now, my next position is Fortis. This is a Canadian dividend stock. I've made that position because it's a beautiful utility company that continues to pay its dividends, but it's one of those boring stocks that doesn't do anything, and that's why it's only up 2.8%. Now, the next position is Granite Real Estate Investment Trust. This is industrial warehouse king in Canada. So I love real estate, but I don't have the capital, nor do I want to start buying industrial land. I mean, it is way better than retail right now. So I'm in a position Granite REIT because it has predictable dividends and it's a boring stock. But surprisingly, it's been doing really, really well this year and is up by 21.8%. But the reason why I invested in them is because actually of for its dividends. Now, the next stock is InterRent REIT, which is another REIT. And, I love real estate. And this one is a player in office buildings. So where they convert office buildings, where they're underutilized, under market value, it needs a lot of renovations and they convert it into, modern buildings. Now, of course, office REITs haven't been doing so well. So it's getting slammed and it's down 18%. But this is not actually a dividend player. I mean, does pay dividends, but I really was hoping this would be a capital grower. So I guess time will tell if this one really pans out. The next one is Manulife Financial. It's an insurance company, and it's a dividend, beautiful, growing stock. Now, of course, this stock hasn't been doing so well. It's one of those boring stocks, but because of the pandemic, it's been getting crushed, so it is down by 22%. My next stock is Microsoft, which is obviously a tech stock that's been growing beautifully. Made this position back in 2017 when Satya Nadella was proving his business model with his Azure and just turning around Microsoft. So I made a position in Microsoft and recently the dollar cost averaging, and it is up by 104.9%. The next one is Northview Apartments. I made this position because I love owning real estate, and rather than owning apartment buildings, let some other companies own apartment buildings. And this one actually specializes up north. Back in the day, I used to travel up north a lot, and I knew there's huge waiting lists getting into these apartment complexes. So this is why I made a position in North Apartment REITs. I didn't expect very much. I was only just hoping to just keep getting its dividends, but it surprised me. It's gone up 59%, and I've been making position for about 4 years. The next one is RioCan. Now, I started making positions about 2 years ago because it was getting slammed with having Target and Sears bankruptcy. And of course, now recently in the pandemic, it's like as if no one's shopping again. So it's one of the stocks that just pays its dividends. And that's really why I invested in them. And of course, they were undervalued for a long time. And this is in between a dividend player as well as an undervalued stock. So we'll see how this pans out. It might take a couple years for this to really turn around. So I am down 11% in this stock. Now my next one is a tech stock. It's a tech growth stock, which I've recently invested in, which is Square. It had amazing, surprising earnings. I thought that all the businesses are shut down. So why would Square actually do well? Well, it was a surprise back a couple of months ago. So I started making position in Square, and I'll be talking more about it in my upcoming videos. But right now it is up by 20.3%. This is a tech stock that is a growth stock. The next stock is a boring stock, TELUS, which is another dividend stock. Hasn't been doing much, and you can see that its stock price hasn't been doing much. It's only gone up 1.3%. Started making this position last year and it's pretty much done really nothing. Okay, then my next stock is Tesla. Needless to say, this is the biggest growth stock I've ever had in my entire stock portfolio. It's up by 42.7%. I started making position just when Tesla announced 4 profitable quarters. Now, this is a dividend stock. I made a position in because I love its dividends. It's been growing year over year, and it actually has a little bit of capital appreciation. It's one of the best Canadian bank stocks, in my opinion. And although bank stocks haven't been doing so well, I would say TD actually has fared actually a-okay. It's only down 5.6%, and I've been buying this pretty steadily over the past year and a half. Now, my next stock is a speculative stock. It's Very Good Foods, and I made a video up here, so check it out. Now, this is I bought this stock at initial public offering because I am on the plant-based trend. I love Beyond Burgers, well, at least my kids do, and I do really, really like them. But I want to continue supporting Canadian businesses. So I made a position in Very Good Food, which is the plant-based alternative that's available in Canada, and they're growing really, really fast. So I made a very small position, and it's already done decently. It's up by 18.4% over the last couple months. The last position is Walt Disney. I bought them because there's so much revenue potential in them. I would say they are considered a growth stock. Now, of course, they've been getting slammed lately because all their resorts are closed for a very long, long time. So we'll see how this plays out. But this is considered a growth stock because their revenue is growing beautifully. Well, except for this year. And we'll see how the next few years pans out. Now, what do these stocks make up in my entire portfolio? Because I showed you ups and downs. So you can see that the majority of my growth has been tech stocks. They make up like a huge percentage of the returns in my entire stock portfolio. You can see that actually my dividend stocks, even though they're down, a lot of them are down because they're banks, they actually don't really make a dent in my entire portfolio because I haven't been making sizable positions in them. I've been making my biggest positions in the tech stocks because that's really what I love investing in innovation. And that's really what I understand the most. So hence why I've been investing heavily in tech stocks. So you can see that the majority of my returns have been Apple, Microsoft, Amazon, Tesla, and a couple REITs. And then the very minuscule downs have been my bank stocks and a couple of REITs being even RealCan and the InterRent REIT. So very, very small percentage of my entire portfolio because it's mostly green. Now that what I want to talk to you about, the most exciting part of this video, I know you're saying, boo, it's actually not exciting, but it's so important, is about taxes. So with these stocks, the reason why I've been investing the way I've been investing is because of the different counts that I have. Did you know that if US stocks actually paid you a dividend, the Canadian government, or actually the American government, withholds 15% for every dividend it issues to you? That means that you get taxed 15% every time an American stock pays you a dividend. Now, I didn't know that when I invested in Apple. I knew it paid its dividend, but I didn't realize the consequences. So I actually invested Apple in my tax-free savings account, as well as in my locked-in registered savings plan, which is essentially like another, it's a locked-in pension plan. And because I did that, those dividends were getting killed 15% year over year. Now, I'm sharing this so that you don't have to, you can avoid the mistakes that I made. So if you buy American stocks that pays out in dividends, please save them in your RRSPs, okay, your registered retirement savings plan, which is the equivalent to the 501k in the US, except in Canada, you don't get taxed if these American companies pay you dividends. But if you save it in your TFSA, you're going to get hit. If you save it in your LRSP and those American stocks pay you dividends, you're going to get hit with a 15% withholding tax on those dividends. Now, when it comes to capital appreciation, if you have a lot of these growth stocks that are growing beautifully and they're American stocks, the best way to not get taxed on them is save them in your RSPs, save them in your TFSAs, because if they grow and you sell, you won't get taxed on those stocks. And then if you invest them in the RESP, same thing. You can harvest all that growth and just let it grow beautifully in those types of accounts, being the RESPs, RRSPs, and TFSA. Now, if you have a corporate account and you're figuring out what's the most tax efficient way for holding investments, the best way is owning Canadian dividends because it gets taxed less in a corporate account. The next one is capital growers, so growth stocks. If they grow in your corporate account, you don't pay taxes until you sell. And then REITs, they don't get taxed actually really well in your corporate account. So invest heavily in Canadian dividend stocks or in your corporate, because if you own Canadian dividends, they get taxed. You get dividend credits. And then secondly is if you own growth stocks, you can own them in your corporate account and you won't get taxed until you sell. Anyways, I hope you found this super, super helpful. If so, give me a thumbs up, hit that like button, and I'll see you in the next video.